I want to highlight how to protect your investments. It's a very good strategy for surviving market bubble. How do you protect your investment from the inevitable market bubble that proceeds, every uh, that precedes the former market cycle, former stage or phase of the market cycle. Number one is you conduct thorough valuation analysis. You conduct thorough valuation analysis. So you rely on valuation metrics like price to earning ratios, price to book ratios, price to sell ratios, and as well as some dividend yield to assess whether assets are undervalued or not. So avoid investing in stocks with inflated valuations. Even if the market sentiment is strong, avoid investing in overvalued stocks so that you don't get your fingers burnt. Avoid them. Number two is diversify your portfolio. Diversify your portfolio. So you spread your investment across different asset classes, across different sectors, different industries, and if possible, you spread your risk, across different geographic regions. And so diversification reduces the impact of a bubble, in any single market segment, cushioning your overall portfolio from severe losses. Number three is maintain cash reserve. You maintain a cash reserve. So holding cash or cash equivalent or cash equivalent provides flexibility and a buffer during market downturns. You will be positioned to buy undervalued assets after the bubble burst, enhancing your long-term gains. So when the bubble bursts, of course, prices will go down. If you have enough, gunpowder, you have enough capital, enough cash, and you could buy very nice companies at discounts. Number four is you set a stop loss orders. This is what is called stop loss order. So implementing a stop loss order can help limit your downside risk by automatically selling assets if it falls, to a predetermined price, protecting, you from severe market decline. Once the price gets to a particular predetermined level, the system will automatically sell your holdings or sell your stocks. Number five is focus on defensive stocks. Focus on defensive stocks. Invest in sectors that tend to be less affected by economic cycles, such as consumer staples, health care, as well as utilities. These stocks generally maintain their value better during market corrections. They're not as affected as other stocks in the market. Number six is rebalance your portfolio regularly. There is need for regular portfolio rebalancing. As bubble inflates asset prices, periodically rebalance your portfolio, to ensure you maintain your desired percentage asset allocation. This prevents overexposure to high-risk sectors and equally help you to lock in gains. Nobody goes broke, taking a profit. Please subscribe to this channel and like this video. All right, that's the only way you can appreciate the education you are receiving. They do well to subscribe and like this video because content creation, particularly of this nature, is not easy. And so the catalyst, the encouragement comes from you subscribing. Please do. It will help me a lot. Number 7 is avoid leverage. Avoid borrowing as much as possible. So avoid borrowed money to invest. Using borrowed money to invest will it will it will amplify your gains, and at the same time will equally amplify your losses. It's like a double-edged sword. It's a double-edged sword. So avoid margin investing during speculative period. Investing on margin, borrowing money to invest. Before you receive that dreaded margin calls to put in additional capital, or else they're going to sell off your shares to to cater for the losses sustaining the portfolio. Number 8 is monitor market sentiments. So stay informed about market conditions and sentiments. You need information. So if there's a widespread speculation and excessive optimism, consider reducing your exposure to higher risk assets. When the market is euphoric, it's time for you to do what? To consider reducing your holdings. Sell off some stocks in highly priced stocks or investments, as the case may be. Number 8 is monitor market sentiments. I've discussed that. Number 9 is invest with a long-term perspective. Invest with a long-term perspective. So focus on the long-term fundamentals of your investments. High-quality assets with strong fundamentals tend to recover faster after market correction, helping you ride out volatility. So the higher the asset quality, the faster it will recover during market correction. So make sure you own quality companies. Number 10 is consider hedging strategies. Consider hedging. So use financial instruments like options, like inverse ETFs. I think I will take time to do videos on inverse ETFs. Inverse ETFs or gold to hedge your portfolio against potential losses. So these strategies can provide protection when market turns volatile, because they don't correlate with stocks. Gold don't correlate with stock. In the case of inverse ETFs, if the benchmark is down, the ETF does performs well. So in conclusion, protecting your investment during a bubble requires a disciplined approach, emphasizing valuation, diversification and risk management. By taking protective steps, you can safeguard your portfolio and be well positioned to capitalize on the post-bust recovery opportunities. The market will recover, and if you have cash at hand, you could benefit from that recovery phase.